Welcome to the InterMarket analysis video update. This is a video that I do once a week where we look not only at other stock market indexes, we also look at the S&P 500 on a valuation basis, but we look at other sectors, other stock indexes, and even other markets. We follow interest rates and what's happening there. We also look at the commodities markets because sometimes what's happening in a different market can ultimately have an impact on what happens in the S&P 500. This is being prepared for Monday, April 1st. The first area is S&P 500 valuation. The first area that we look at is we look at historical figures to go back and see, okay, based on past earnings reports, what is the stock market valued at right now? Then we look forward to what analysts are projecting and what forecasts may be happening into the future to see, are we overpriced? Are we fairly priced? Or are we underpriced right now? This first chart looks at a thing called the PE ratio, the price to earnings ratio. We don't use this to make decisions. Some people do, but the way I approach the market is I just want to know about this, but I don't make decisions around this. You can see that the red dashed line, that's the PE ratio of 20. When we're at that level or above it, the market is considered to be expensive. In between about 11 and 19, the market is considered fairly priced. That's the blue dashed line. And if we're at 10 or below, the market is considered to be inexpensive or cheap. And we're well above all three of these lines. In fact, down below, this is a blow up of the current price of the S&P in relation to the PE ratio of 20. So looking back over a period of time, we can see that the market spends a lot of time above the red dashed line, and we've been above it for years now. So that's why it's not really a good timing mechanism. This is just for informational purposes to let us know where we're at with things. This is another look at that same concept by looking backwards, going back to 1980 and different events that have happened in the market where the S&P is now in relation to the PE ratio of 20. We also look at another method of looking backwards called the Shiller PE ratio, developed by Robert Shiller. You may also know this as CAPE, C-A-P-E. This takes a more smooth approach over a period of time to try to take out any anomalies or outliers. And his figure right now is coming in at 35.14. To give us some context, we can look at a couple of different things. We can look at the historical chart going back well into the 1800s. And right now, we're at a pretty high level when we just look at other things that have happened, like the 1929 crash, like the 1987 crash, the whole dot-com boom and bust, the whole COVID lockdown, all the different things that have happened. We've come back to a reading of 35.14. To give us a little bit more context, we look at the median and the mean, where we're just about at 16 all the way up to 17 when we look at these averages over a period of time, looking at them in a couple of different ways. So we're almost double what the median and the mean price it would normally be during this time. So you can look at the market right now and go, yeah, it's expensive, but it keeps going up anyway. And it could go up for quite a while. And it uses earnings going into the future to justify these higher prices. That's what we look at next. We have the red line here, which is the forward PE ratio. And this was registered as of March 28th. So that would be Thursday because the market was closed on Friday for Good Friday. We're coming in at 21.1. So even looking forward, we are considered to be expensive. Now the market can last in this condition for quite a while. If you want to take another look at mid caps and small caps, that's where we see the blue line and the green line. They're not as overvalued right now. When we look out into the future, we're coming in at 16.5 for the mid caps and 15.4 for the small caps. So they're more fairly priced. Or the S&P, which has a lot of tech companies, the Magnificent Seven, the companies that have really been going up. That's why we're seeing a much higher PE ratio, even going forward from here. Now, at some point, the market may decide to deal with this, but things are looking quite positive right now. But just be aware of that. Tuck that into the back of your mind that at some point, either earnings are going to need to go up on a forward-looking basis, or price is going to need to come down, or some kind of a combination between the two. Another area that we look at is growth versus value. Now, this past week, we saw value doing really well, and the market hit all-time highs. So the market can go up when value is doing well, but we're seeing a real shift in the economy right now. When the market really has some strength to go higher, it's when growth is outperforming value. Well, they're both doing pretty good right now. So the first chart that we look at here is just a growth index where we can see that it is in a solid uptrend when you look at it all by itself. We look at a value index as well, which is also in an uptrend. Where we can get some insight is when we do a ratio between the two. On top, we have a growth to value ratio showing how growth is outperforming, but you see how it really dipped down later in the week as value was starting to outperform. This is where we're seeing a potential shift, and I'm going to try to point out as we go through the different charts in this video. Down below, we have a value to growth ratio where it has been underperforming, but lately it's been coming back up. The reason why I do multiple charts and we do inverse charts and so forth is you can see that there's a little bit of an offset here when this moving average actually crossed over. And when we're making decisions, there are people that use the growth to value ratios to determine their portfolio or what kind of stocks they're going to focus on. You want to make sure that you're seeing the same thing at the same time. And taking that to the next step, we also look at another ratio. This is longer term, showing how growth is outperforming value. Right here, here's an inverse showing how value has been underperforming growth. And we want to keep an eye on this because if it really starts to turn, that can mean that the market might be getting more defensive. And usually value is a better place to be when we're in a sideways to even declining market. Here's another look at a growth to value ratio showing how growth has been outperforming, but lately coming back. And then here's a shorter term look showing how value has been underperforming, but starting to bounce up a bit. Then we look at another ratio here showing how growth has been outperforming value, but we are seeing some weakness right now. Here's another look using ETFs, comparing growth to value, where it has been really in an uptrend above the lines in this rainbow chart, but lately the ratio has been coming down. We want to watch this. We're seeing where value has been underperforming, but starting to turn back up. Then we break it down a little further and we look at small cap growth to value. And it really shot up and then we started to go sideways, but now we're seeing a little bit of a trailing off here. We just want to see if this is going to continue. The index is really lagging behind. It is breaking out a little bit after Thursday, but this is the last main index to set an all-time high, and it still has quite a ways to go to do that. We also look at a growth to value ratio for the mid caps. Now, this index has been a lot stronger and is recently coming off setting an all-time high. The ratio that we look down here at the bottom, this has been a lot stronger and has been in more of a solid uptrend, but even it's been pulling back lately. And then we look at S&P growth to value on a ratio basis where it's still in an uptrend, but it has been pulling back. Is this part of a shift that's going on in the market? Is this going to continue, or is this just some kind of a short-term thing that is going to happen before we see this ratio start to go back up? Or is the market starting to get more defensive in preparation for some kind of a decline? Now, there are times when this ratio is going down, like we're seeing right here, and the index can go up, like we saw before. But when we see the real upward thrust of the index, that's when we see the growth really outperforming the value on a ratio basis. We also keep an eye on inflation. Now, this is a monthly chart of the CRB index, and it's been going back up. In fact, on the daily charts, we're seeing a golden cross here. Just to get some perspective, we look at an inflation to deflation ratio. We're still below a declining moving average, meaning that inflation is going down. It is ticking back up. Now, this is a monthly chart, so it takes a while for this to work out. But we want to keep an eye on this too, even though inflation has been coming down. If this continues to go up, that may cause us some concern. Then here's a daily chart of the CRB index, which are different commodities. And we've been seeing some strength here. And we've actually seen a golden cross where the CRB index had been in a downtrend. Now it's starting to go into an uptrend. Now, this is something that I got off of Twitter. Some of the Isabel Net, where I get a lot of charts from, they didn't update things for Friday, and I didn't check for Saturday. So I'm not sure what charts are available, but I thought this one might be interesting. It says interest rate cuts in a non-recessionary environment. And that's what it looks like we're in as of right now. That can change. Something can happen either geopolitically or in the markets to change that. But right now, it looks like we're not necessarily going to go into a recession. And when this happens, it typically can lead to higher commodity prices. And we're seeing all the different commodities here, and I have a lot of charts to show you these things. They can still go up, and the stock market can still go up at the same time. So that's what we're trying to figure out right now. Is this more we're switching an environment and we're going to remain positive, or are we turning more defensive? And I update this every day in the daily videos. This is a weekly video where I update it here. We get a little bit bigger picture look, but please feel free to check out the daily videos to get more consistent updates. We also look at the Baltic Dry Index, which has been coming down, even though it's still in an uptrend. This is more inflationary when it's going up. That just means that it costs more to ship products from one place to another, specifically in the Baltics. And if it's happening in the Baltics, then it may be happening in other places as well. Some other markets that we look at, and we just glance at these just to get an idea of where they're at. The first market is aluminum, where it's still in a downtrend. The blue line is below the red line, but it has been bouncing up lately. Corn continues to be in a pretty solid downtrend. We look at fertilizer here. That's been going down lately. If that's going up, that can be more inflationary. We look at oil, which is starting to actually break out to the upside. We're getting up into the 83 range after we had been in a downtrend. Gas is in an uptrend, and we're seeing a recent golden cross here, and you're probably experiencing that every time you fill up. We look at diesel prices, which have been going up a little bit here, but they're not really moving up with any fierce action. This is mainly for railroads and for trucks, big trucks that have to ship products all over. Here's heating oil, which is still in an overall downtrend. Natural gas has really been just getting hammered here and is in a pretty solid downtrend. Copper has been doing a little bit better. Copper tends to do better when the economic outlook going forward is more positive. We are in an uptrend, but over the past few trading sessions, copper has been pulling back. Then gold, and that seems to be what a lot of people are talking about here. We look at a ratio between copper to gold. When this is going up, that means copper is outperforming. When this is going down, that means copper's underperforming or gold is outperforming. And with gold going up and setting all-time highs, it has been outperforming copper. This is a longer term look at that same chart where we're still basically headed down with the copper to gold ratio. To give it a little more context, I plot the 2-year yield and the 10-year yield where they tend to move in the same general direction, but the spread between these are quite wide, even though they're on different scales. We're inverted as far as interest rates are concerned. And we're wondering, are things going to switch? Is this chart going to take on a different character going forward from here? It hasn't really changed all that much now, but we want to watch this on a pretty consistent basis. Here is gold, and I just follow the ETF. I follow the futures contract, which is a little bit higher in price right now. But for the videos, I mainly just show the gold ETF, which is hitting an all-time high. Silver, it's just starting to get into an uptrend here. It had been in a downtrend, had been really underperforming gold. Well, the longer it's spent above both of these moving averages, the more likely we were to see a cross. And that's what we're seeing right now. Then we look at the closing value for gold on top and the closing value for silver on the bottom. And we can see that on the bottom here, this is a correlation between the two. Now, you would think, logically, that if gold's going up, silver should be going up too. And they are to a degree, but not with any real conviction. This is actually giving us more of a neutral rating. Sorry, and I have to continually clear my throat. Where gold is really breaking out, and silver, yeah, it's kind of turning up, but it's not breaking out above previous highs. So this is leading some to think, well, maybe silver's the place to be right now. Other people are already chasing gold, and we've been seeing it pull back just a little bit. And there's all these people out there that think gold is just the ultimate investment. And it may be for some people, but where I make decisions is by looking at these charts. I don't listen to all these pundits out there. I like to look at all this information and then decide for myself what I think is actually happening. Then we look at a gold to silver ratio. When this is going up, gold is outperforming silver. When this is going down, silver is outperforming gold. We've been pretty choppy lately, but we have been going back up as gold has been outperforming. Now, sometimes, not right now, but sometimes we can plot the US dollar index down here, and they can often have a high correlated relationship. When we get a high reading in the correlation area here, that means that the top part of the chart and the middle part of the chart are moving in tandem with each other. Well, that's not really happening right now. This is actually going down and giving us more of a neutral reading. Here's the dollar index. This could be some pressure on stocks, as we're seeing a golden cross here on the daily chart as the dollar has been going back up. The stock market likes a weaker dollar. It's better for the exchange rates. It's better for import and export prices, and it looks better on their books from an accounting perspective. And so they like it when the dollar is actually weaker, and the fact that it's showing some strength might cause some issues. We look at the euro to the dollar, where we just look at a blank chart up here of the euro, and here's the dollar index down below. We also keep an eye on the Japanese yen, and then I have breakout charts here. Here is the euro to the dollar, and we're just starting to see a death cross here with the euro to the dollar. Not quite there yet, but the euro's been going down as the dollar has been seeing some strength. Now, the Japanese yen, it's in a more solid downtrend here. So that's been really underperforming the dollar. And we look at the British pound, still in an uptrend compared to the dollar, but it has been falling back, coming down to about the 200-day moving average with this ratio. We look at other ratios, and this is a chart that I show in every daily video. This is the S&P 500, which is a weighted index. So the big companies, based on their capitalization, they have more of an impact on what the S&P does day in and day out. Well, another index is the equal weight index, where all of the stocks, there's 505, I believe, right around 500, they're all treated the same. So that's the red line. And when we see the red line actually doing as well, if not better, than the S&P 500 weighted index, that means there's more broad market participation. And that's what we want to see in a good, healthy environment. Everybody's been talking about the Magnificent Seven and how they've been really leading everything higher. This pretty much dispels that. We're seeing a lot more broad market participation now. We look at another ratio, the equal weight that I just talked about, and then the S&P 500. Now, when this is going up, that means the equal weight index is outperforming, but we have been going down lately. So it's not quite back to outperforming yet, as the S&P is just going and setting all-time highs. The equal weight index, yeah, it's showing some signs of improvement, but it's not really turning into a full-blown uptrend when we look at this ratio. We also do another ratio between stocks, the S&P 500, and commodities, the CRB index. And even with the CRB index showing some improvement, stocks are still continuing to outperform. Here's an inverse of that same chart showing how the CRB index is underperforming. Then we look at the NASDAQ 100 and compare it with the S&P 500. Now, there is some overlap between stocks that are in the NASDAQ 100 and they're also in the S&P 500. But this past week, we saw the NASDAQ 100 actually be down on the week, and folks are getting into some different stocks. And that's why we're seeing this going down. Now, we'll want to watch this to see if this continues to fall, or is this some kind of a short-term thing that is actually happening. Then we look at the S&P 100, which are the biggest stocks in the S&P 500. This is also in an uptrend longer term, but it has been coming down lately as the bigger stocks have been underperforming the broader market. We look at the NASDAQ, which is near all-time highs, and the S&P 500 near all-time highs. Well, the NASDAQ has got a lot of tech stocks in it. Well, it's still outperforming longer term, but it's been underperforming more in the short term. Here's the NASDAQ 100 compared to the NASDAQ. Outperforming in the longer term, underperforming in the short term. The mega cap growth. This is the Magnificent Seven and probably some other ones thrown in here compared to the equal weight index that I talked about earlier. The mega caps are still in a longer term uptrend, but we are seeing them pull back. We want to watch this to see if this is going to continue. Here's another thing. Small caps, they're lagging behind. There's a lot of talk about maybe small caps are the way to be now. Well, when you look at this on a ratio basis, that's the red line comparing the small caps to the S&P. You know, we're bouncing back up a little bit, but we're not really going up with this ratio right now. So even though small caps are showing some improvement, they've got a lot of way lot of ways to go to really start looking more positive. And we've been fooled by this right near the end of 2023, the so-called January effect that only lasted for December. That's when we saw this really spike up. It's not spiking up right now. We want to see this show some real solid strength if we're going to be more favorable towards small cap stocks. This is another ratio between the small caps and the S&P 500, showing the longer term trend is clearly down, even though we've been bouncing back up lately. We did show some improvement in the latter part of 2023, only to see most of that given back and go back to underperforming. So we just want to watch this to see if there's any follow through to this. Here's the biggest software companies in an uptrend right now, but still having quite a ways to go to get back to their all-time highs set in 2021. Here's the mega caps. This is what everybody's talking about, and people that don't know anything about stocks are suddenly investing in some of these stocks. They continue to be in an uptrend. So yeah, you can't doubt that they are still solid. Are there people just getting sucked into this before we see a pullback to wipe out a lot of the weaker hands? I don't know. It's happened before, and it may not happen right away, but it may happen somewhere along the way. Here is the robotics and AI ETF. That's the whole craze right now. This is the ETF by itself showing that it's in a pretty solid uptrend, even though it came down the last few trading sessions. And when you compare it to the tech sector, it has been really underperforming, showing an improvement, came right up to this longer term moving average, which is a 250 period moving average. So it's very long term. And now it's been bouncing back down. We want to keep an eye on this one as well. This is the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together into one average. And the transports have not been doing well. The utilities have really not been doing well. So most of the strength that we're seeing here is coming from the Dow itself. We look at the S&P 500 and do a ratio with 1 to 3 year bonds, showing that stocks are still outperforming the price of shorter term bonds. We look at a broad market measure known as the S&P 1500, and we compare that with shorter term bonds. This is also showing where stocks are outperforming bonds, meaning it's not just a few stocks. This is spread across 1,500 stocks, and this is still outperforming. So this is seeing more broad market participation. And we look at another broad market measure, and we compare it with a little further out bonds, showing that stocks are outperforming the price of bonds here as well. This is a total U.S. stock ETF. This is about as big as it gets with 2,651 stocks. I know there's a thing called the Wilshire 5,000. At one time, it had 5,000 stocks, but it doesn't have anywhere near that now. It's lower number of stocks than this ETF. This is showing that we're in a solid uptrend, meaning that it's not just the big stocks that are really doing well right now. This is really close to all-time highs. Here's the low volatility ETF. When you look at it by itself, it's in an uptrend. These are stocks that folks get into when they're more defensive, when they're afraid that we're going to go sideways or get into a decline. And we've been in an uptrend now since since August or October, when we hit the low in stocks. This has been bouncing back up too. This is more defensive. You would think we would see this actually going down, but it's actually in an uptrend right now. But when you compare it to the S&P, it's really underperforming and just in a pretty solid downtrend with this ratio. Now I'm going to look at the tech sector and compare it with 3 to 7 year bonds. Even though it's pulling back a little bit, we're still looking really solid, showing that the tech sector is continuing to outperform. And we look at different studies of stocks. This is the advanced decline line studies, and I show this in every daily video, but I also want to include it here since some of you don't watch the daily videos. Well, we're starting to break out with the NYSE common stock. This is not the whole NYSE. This is just the common stock, which is what most investors buy. We're also breaking out with the S&P 500. We are breaking out with the mid caps. We're doing better with the small caps, but we have not been able to surpass the high that we set back in December. Here's Dow theory. The basic idea behind Dow theory is there's a number of different things, but the takeaway from this, when the Dow is at or near all-time highs, that should be confirmed by the transportation index. It's not doing that. The transports are looking better, and it would be nice if they continue to go up, but they haven't even been able to break out of this range that we've been in for quite a while now, let alone this all-time high. If this could really start to go up and show some improvement, maybe if we're getting into a more interest rate friendly environment, that might help the transports. And once this goes back, if it does, and actually sets an all-time high, that would be a Dow theory confirmation. Until that happens, this is a Dow theory non-confirmation. And this is what the perma bears are really latching onto right now, is justification that things are going to fall apart. Utilities have been bouncing up lately, but overall continue to be in a downtrend. Here's a look at the transports by themselves. Well, we're just barely coming back and getting above this high set in late 2023 and then into 2024. So yeah, it's looking better, but we want to see it do even better than this if we're going to turn more positive to get back to the high set back in the summer of 2023 and then the all-time high, which was set back in 2021. Then here's a ratio. And it's been bouncing back up when we compare the transports to the S&P. When this is going up, the transports are outperforming the S&P. When this is going down, which is what it's been doing until this past week, it just shows that the transports are continuing to underperform. But we want to see more of this bounce if we're going to turn a little more positive to the transports. We look at a ratio between the Dow and the transports. When this is going up, the Dow's outperforming. When this is going down, the transports are outperforming. And it's been pretty choppy, so we're not getting anything real definitive here. We look at another correlation with the S&P on top and the transports in the middle, and then seeing that there's a fairly strong correlated relationship. The higher this reading is, the more they're going in the same direction at the same time. So if the S&P continues to go up, maybe, just maybe, the transports can continue to go up as well. Now, this also works the other way too. If they have a strong correlated relationship and the S&P goes down, the transports may go down as well. And then this is a new take on Dow theory, because some think the Dow theory is antiquated because the Dow is only 30 stocks. And instead of using the Dow, maybe we should use the S&P 500. That's more of indicative of the real U.S. economy. And we're right at an all-time high after Thursday's session. Then instead of using the transports, because we don't all travel around by train anymore, we do fly and so forth. And believe me, Boeing's having a lot of trouble these days. But the NASDAQ has a lot of tech, and that's more conducive of the U.S. economy now. And these are confirming each other, where we're close to all-time highs with the NASDAQ, and we're setting an all-time high now with the S&P 500. To break that down a little further, let's look at the weak equal weight index. This is getting close to an all-time high, but it's still not necessarily outperforming the S&P 500 weighted index. And the QQQs, even though they didn't have a really good week this past week, we look at an equal weight QQQ ETF, and this is holding up a little bit better, also just coming off of recent all-time highs. So this would be Dow confirmation right here, Dow theory confirmation. Then here's the Wilshire 5000, which up until about a year ago, I relied heavily on this, but then they messed it all up and changed the symbol, and then I wanted to let this run for a while before I started using it. This is another broad market index that we follow. When the blue line is above the red line, we are in a solid uptrend, and that's what we're seeing right now. The FANG index, Facebook, Apple, Amazon, Netflix, Google, and some other ones thrown in, not as strong this past week. We've been pretty much chopping sideways. We're still in a longer-term uptrend, and these stocks have still done very, very well, but they're just not really doing all that much right now. And then if we do see some weakness, especially in the FANG index, we'll be looking at other lows here to see if some of these may provide support if we start to fall. And then I have some lines here that I'll keep an eye on, but we've got quite a ways to go for that to happen. But these are things that I look at on a daily basis, and then when they become relevant, this is when I really start talking about them. Here's ARK, which is in an uptrend, but not really participating in the big upward move. We have the S&P setting all-time highs, and ARK is like way below its all-time high. And that's frustrating a lot of people. A lot of people considered Cathie Wood really like a rock star of stocks and really bought into her philosophy on things. And so they sunk a lot of money into ARK, probably as it was going up, and got in right about at the top, only to see a lot of that vanish, and it's really not coming back. Now, there's always the promise or the hope that maybe someday it will, But what kind of time is that going to take? What if something happens between now and the good days again that really drags this even lower than where we're at now? And then we look at another ratio between the S&P and then a global index, looking at stocks in Europe, Australia, Asia, and the Far East. That's the ratio that you see plotted here, and it's above a moving average. So this means the S&P 500 is outperforming global stocks. Down below, we plot an oscillator, a momentum oscillator, and this is continuing to go up, showing that the ratio is still looking really solid. Then we look at bonds. This is a total bond ETF where we are in an uptrend, but we've been chopping sideways a lot as interest rates are trying to figure out where do we go from here. Here's a world bond index, which is also really choppy here, but we're still in an uptrend, believe it or not. The blue line's above the red line, but we're also dealing with this red line that's been on this chart for years now as the market's trying to figure out what's going to happen going forward, especially with the Fed possibly lowering interest rates in 2024. Here's a longer term look at the stock to bond ratio, showing how stocks are outperforming bonds. Here's a daily chart, which is showing that same thing in reverse, showing how bonds are underperforming stocks. So longer term here, monthly, and then I also do a weekly video where I look at weekly charts of these things, and then on a daily chart. So pretty much across the board, stocks continue to underperform bonds when you're looking at bonds based on price. Here's high yield corporate bonds, which are junk bonds, and these are right at or near all-time highs, and they're holding up quite well and in a really solid uptrend. More conservative bonds, they're in an uptrend too, but they're not breaking out to all-time highs. They have quite a ways to go. These are more conservative. When we finally top out with interest rates, and maybe that's now, we're not really sure, and then longer term interest rates start to come down, the yield curves are no longer inverted, and then if we're able to avoid actually going into a recession, then we would see this chart show a lot of improvement as folks are locking in higher rates, thinking that rates have topped out and they want to lock in 10-year, 20-year, 30-year bonds. But right now, the market is going through that process of trying to decide what's going to happen. Then we look at a ratio between the riskier bonds, which are junk bonds, and then more conservative bonds that aren't as risky. And the riskier bonds are outperforming, but you notice since the Fed made their announcement that they are turning more dovish and possibly we could see 3 rate cuts in 2024, you see how this is coming down? That means folks are slowly but surely getting out of the riskier bonds, and they get into those because of the higher yield. Well, if interest rates have really topped out and the Fed's getting ready to cut rates, that's going to eventually come over into the interest rates that we see in the different maturity of bond yields. And so we're starting to see this come down. Now, we would expect this to continue to come down if we're going to be in a declining interest rate environment. Then we look at a stock to bond correlation. And right now, you look at the price of stocks and the price of bonds, and they're tending to go in the same direction at the same time. So if stocks are going up, bonds are probably going up. And if stocks are going down, bonds are probably going down. Then here's the Dow Jones Corporate Bond Index, which has been going sideways, but it is in an uptrend as we're seeing some improvement over the last 6 months or so with corporate bonds. Here's the 10-year yield with Fibonacci lines on here. We hit the 5% level last October, and then that was the top, and then we started coming down, and that's when the market really got in gear. Well, then we started to really drift higher with interest rates and that was putting some pressure under stocks at the beginning of 2024. And then we saw interest rates really go down, but then we saw this spike up after CPI and PPI came out. And now the market's kind of slowly starting to go back down again. This is a long-term look at the Treasury yield where we go all the way back. And for 40 years, we've been seeing lower highs and lower lows as interest rates have been inching their way lower during that time. Well, over here on the right, we're inching our way back higher. And we're wondering, are we seeing a general shift in the interest rate environment? Are we going to be living in a world where we go back to, and over on the right, this is more normal. What we've seen over the last 40 years is not necessarily normal. And so that just requires different people to make different decisions if we are, in fact, going to a higher interest rate environment. Then this is a chart that I've been showing for a long time now. And the reason I show this is way over on the right. We hit a really low level with this and then bounced up off of that. And it was like, this was when the market really thought that the Fed was going to start lowering interest rates and we were going to have a soft landing, meaning that even though we've seen economic slowdowns, we're going to avoid going into a recession. Now, please take into account that there's the economy as far as the stock market is concerned, and then there's the economy as far as people are concerned, and there can be a real disconnect between the two. Well, this was considered to be good news. Well, other times when this happened, this was after the COVID plunge, and this was after we had a real crisis with the euro. Well, these were two negative things, and this is considered to be a positive thing. We don't usually see this kind of a reading on good news. That's why I keep showing this chart. Even though this is months old now, this happened back in October of 2023. We just want to keep this in the back of our mind. Is this going to turn into something negative? Right now, no. It's a positive Goldilocks scenario. And this might be just an exception to the other negative things that have happened. Here's the 30-year yield, which really isn't near any of the Fibonacci levels right now. This is a ratio between stocks and the 10-year yield, showing how stocks are outperforming the 10-year yield. And then this is stocks to 3 to 7 year bonds. When this is going down, that means bonds are underperforming stocks. Here's junk bonds. They're really near, or if not at, all-time highs currently. And then we look at a ratio, junk bonds, riskier bonds, and then the bond ETF, which are more conservative, more government bonds. And we would expect to see this ratio starting to come down if we're actually topping out with interest rates. Folks are getting out of the junk bonds and jumping over into the government bonds because they're safer. We're not really seeing much of a move yet here with this ratio. And we look at an ETF of the 7 to 10 year bond. This is more intermediate term. The 10-year bond is what I use as the benchmark. And so that's why I want to keep an eye on this ETF. We're above the 50-day moving average. We're in an uptrend. The RSI is above 50, and we're starting to turn positive with momentum. And this is based on price. So if this bond ETF keeps going up, that means interest rates will go down. Here's a daily chart of the yields at different maturities where we had been declining. See, we topped out here in October, and then we just started screaming lower as the market was just at breakneck speeds to go higher. And then we kind of leveled out, went up, went down, went up, went down. We started to go up after CPI and PPI came out. Lately, we've been going down, but we still have inverted yield curves that we're dealing with. This is a weekly chart looking internationally. We have the US and UK on top. The US has the highest rates. German rates are in blue and Japanese rates are in red. And then we look at a thing called the MOVE Index, which measures the volatility of bonds based on price. And volatility has really been dropping off when you look at this by itself. And there's not a lot of fear in the stock market. That's what we use the VIX to try to measure. And this is giving us very low readings. Right now, the correlation between the two is pretty strong. So if we're seeing volatility dropping off in stocks, it's probably also dropping off in bonds and vice versa. Then we look at a monthly chart of the long-term bond, and this continues to be in a downtrend. It's below a declining moving average. Then on the bottom, we look at a ratio between the long-term bonds and the CRB index. And even with all the problems bonds have had, they still longer term continue to outperform the CRB index. Then we look at different sectors. And a week ago, I changed the way I do this a little bit. The first chart I look at is there's 11 sectors that make up the S&P 500. And there's no real way that I organize these. It's alphabetical by symbol. So B comes up first because all the other symbols also have XL. So this isn't rating them. This is more of an alphabetical thing where the materials by themselves, they're in a really solid uptrend and just at an all-time high. When you compare it to the S&P 500 though, yeah, it's improving in the shorter term, and it has been since the early part of February, but longer term, it's still underperforming. We're not seeing this ratio crossing over positive yet. Communication, one of the stronger areas, been going sideways lately. By itself, it's in a solid uptrend. And it's also been outperforming the S&P 500, but it has been pulling back lately. And we look at energy, which is in an uptrend all by itself. But when you compare it to the S&P, it's been underperforming, even though since the early part of March, Energy is making a roaring comeback, and it's been one of the stronger areas year to date. The financials, even with all the banking news that happened almost a year ago in spring, and then New York Community Bank, and we're still waiting to see if more information is going to come out, and nothing seems to have materialized to this point as of the first part of April. The financial sector is in a really solid uptrend. And it's starting to break out. When we look at a ratio between the financials and the S&P 500, it's also in an uptrend as well. And then this is another tweet that I found where it says favorable price momentum, and I drew this red line on here. This is a gentleman named Dean Christians, and he says financials haven't done this in more than 50 years. Remember, this group, the credit mechanism, is excellent at providing an early warning before economic contractions and bear markets. So this is what he's saying. If Armageddon was imminent, would they be acting in a similar manner? Meaning they'd be going down if they're predicting doom and gloom going forward. And no, they're really solid right now. However, there's a reason why I drew this red line on here. Yeah, the party may last a little bit, but this is getting into the early to mid part of the 70s. We had the Yom Kippur War. We had the embargo on oil. There were gas lines. I remember I was in third grade at the time. It's the first time I ever heard of something like this. And we saw a real bear market after that. So just be ready for something like this. Now, other times when we had readings, that just marked a continuation that seemed to last longer. And it may last longer this time. But we always need to respect what could happen down the road and be prepared for that. All right. The industrials are in an uptrend and pretty much at an all-time high. And they're showing an improvement here when we compare it to the S&P, not really breaking out with this ratio, getting ready to see a golden cross though. So that would be more positive. Here's the tech sector, one of the stronger areas, all by itself in an uptrend. Has been declining lately when we compare it to the S&P, but still longer term, it's in an uptrend. Staples, the things that you have to have no matter what's going on in the economy. Why are staples going up if the economy is actually improving? That's been kind of a mystery now. And they're in an uptrend when you look at them all by themselves. But when you compare them to the S&P, they are definitely underperforming the rise in the index itself. Real estate, another area that's very interest rate sensitive. Back in October, when we hit that top at 5%, real estate was just going in the toilet and looking to get flushed twice. Then we started to bounce down with interest rates, and we saw just this massive upward move with real estate all by itself. Then interest rates started to go back up, and we're coming back down. As interest rates were falling, real estate's going back up because people, they have to borrow not only to build the house, but to get the mortgage to buy the house. And when interest rates are going up, it's not as attractive to do that. But we are in a longer term uptrend when we look at real estate by itself. But when you compare it to the S&P, it's in a pretty solid downtrend, even though this ratio has bounced up lately. Utilities also are in a downtrend, even though they've been coming back up. When we look at them all by themselves, when we compare them to the S&P, yeah, we're bouncing up here, but we're in a really solid downtrend with this ratio. Then we look at an S&P to utilities ratio. When this is going up, that means the S&P is outperforming utilities, and usually the S&P is going up. And when this is going down, that means utilities are outperforming the S&P, and usually the S&P is going down. So right now we have been going up, and this has been supporting the S&P going higher, but lately we're seeing this fall down just a little bit. Now, there are some times when I show this chart every day in every video, we've been chopping around and being rather indecisive lately, so I've dropped this for right now from the daily videos, but if it really starts to speak loudly again, I will be putting it back in. Then we have healthcare going in an uptrend when you look at it all by itself. But when you compare it to the S&P, it's really underperforming. Discretionary, the thing that makes life fun. Unfortunately, Tesla's in this group, and Tesla's been under a lot of pressure, but it's still in a longer-term uptrend. But when you compare it to the S&P, it was one of the better sectors in 2023, and it was actually starting to go up. Then Tesla has run into some problems, and that's really weighing down this ratio. Semiconductors. This is what fuels all the crypto mining and all the machines that have to run these algorithms to try to find new Bitcoins and new cryptos and so forth. This is in a solid uptrend. Then we do a ratio. Back in 2022, energy really outperformed tech. Well, then we saw a switch where energy was underperforming tech, or to put that another way, tech was outperforming energy. But we are seeing a bit of a bounce back up here, but we're still in a longer term downtrend. Then we look at growth stocks. This is when you want to buy low and sell high, and we compare it with bonds. What would be the better thing to get into? For the last, well, since the early part of 2023, growth stocks have outperformed being in bonds, even though they are pulling back currently. Then we look at the tech sector, which is very interest rate insensitive because a lot of these tech companies have to borrow a lot of money to do the new and exciting things that we get to benefit from. The tech sector is still outperforming the 10-year yield. Here's an inverse showing how the 10-year yield is underperforming the tech sector. Discretionary, the things that make life fun versus staples, the things you have to have. Discretionary is outperforming, but see how it's been just kind of fading here? We want to keep an eye on this one. Here's an inverse of that same chart. Staples underperforming, but starting to show some improvement. Gold, yes, going to the moon, but when you compare it to the S&P 500, it's underperforming. Now, it has been breaking out a little bit against the dollar, but since the dollar has been seeing some strength and gold is seeing a little bit of weakness, we're seeing this ratio coming down just a little bit. High leverage loans. These are very risky loans. If the economy was getting ready to fall off a cliff, we would not be setting all-time highs with this ETF. And we are setting all-time highs. So the people that invest in this, and a lot of this is smart money, the folks that really know what's going on, they wouldn't be investing in this, but they are. And so that gives us a little more optimism looking forward as far as the economy is concerned. The NYSE composite, a broad measure that we look at, is setting all-time highs. All stocks in the US as well as internationally, also in an uptrend. Emerging markets, well, at the beginning of 2023, over a year ago, that was all the rage, and then it just kind of went nowhere. But we are in an uptrend with the emerging markets, but they're not breaking out. They're not really participating with these all-time highs that we're seeing here in the US. The Japanese Nikkei, it's really near all-time highs. It finally broke above the high set back in 1989, and we're still above that level for right now. Microcaps, very small companies, they continue to be in an uptrend. And then we look at the Home Builders ETF, and we're not really getting any insight. I have the S&P on top, the Home Builders ETF in the middle, and then here's a ratio between the two. And what I follow is the correlation on the bottom. What we're looking for is when they're going in opposite directions of each other, and they're not. They're going in the same direction right now. Bitcoin just went up to 73.8 and then pulled back. And as of the time I took this chart, we were just slightly over 70 again. Looking internationally, and this is a long-term chart, we are seeing more of a decline in China. We're rolling over with the emerging markets. We're declining in Europe. We're declining in Japan. And believe it or not, even though we're setting all-time highs, this is the KST. And you may not like this momentum oscillator, but I've been using it for a long time. And I kind of like that it's not necessarily showing us what everything else is showing us. This is actually showing more sideways action. We see a pullback in the S&P, and this could actually end up going lower. Look at an intermarket analysis chart, which is the name of this video. And going back to the beginning of the year, oil is in the lead year to date, followed by stocks, then gold, then the dollar. Bonds are still negative going back to the beginning of 2024. Some correlations. We look at the S&P 500 and compare it to the dollar. They're having a pretty strong tendency to go in the same direction right now. Kind of strange. If the dollar, because the dollar's been going up and stocks have been going up. That's why we're seeing this line going up higher. At some point, they may switch back and go in opposite directions, but that's not what's happening right now. Also, we're more neutral when we're in this blue area to the top and red area to the bottom. We're not seeing any definitive correlation right now when we look at S&P to oil. We look at S&P to the 10-year yield, having a tendency to go in opposite directions. So if interest rates are going down, that likely is giving support to stocks. But we saw a period of time earlier in 2024 when interest rates was right up around in here. Interest rates were going up and stocks were going up at the same time. And we look at the tech sector and compare it with the 10-year yield, also pretty strong tendency to go in opposite directions. Then we look at a shorter yield, the 2-year yield, and compare it with the S&P, also a tendency to go in opposite directions. And we look at some very long-term secular, which can span decades, as well as cyclical. This can be like 2022 was a cyclical, okay, let me try to say this right. A cyclical bear market within a long-term secular bull market. Now, some people would not have agreed with that in 2022. I do. I think that's what was actually happening. But if you want to get tripped over definitions and not really focus on what's truly important, then by all means, go for it. Here is a monthly chart of the NYSE, and we're above the moving average and going higher. That's positive, longer term. The Copic curve, a momentum oscillator, is going up. So longer term, the NYSE is looking quite positive. This is a daily chart of the NYSE, also right at all-time highs. This is another measure that we use called the record high percent index. When this is going up, that's positive for the NYSE. We look at the S&P on top. This is a monthly chart, and we're above the moving average. And we look at the longer-term momentum, and that is going up. So in the short, intermediate, and long term, when we look at the daily charts, we're looking good. We're looking positive when we look at the weekly charts, and I go over that in the weekly video. And then this is a monthly chart, and this is also looking good. So we're seeing confirmation across all time frames. Then we look at the S&P on top. This is back to being a daily chart now. And then a ratio between stocks and the CRB index showing how stocks are outperforming. We look at the S&P and another global index showing how the S&P is outperforming. Now, this is a monthly chart, and we're pretty much right on top of the moving average with the KST. It's going to take some time for this to work out. And if we stay positive, we would see this turn more positive with this indicator. Then at the very end of this, I go through a list of all the things that are positive, and it's getting kind of long here. And my definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. Now, that may be simple, but this is something that I just use. It's something relatively easy to understand. It's long-term enough to give us more of the intermediate to even long-term trend with taking out a lot of the noise. So we have the growth indexes by themselves, the value indexes by themselves. Copper is in an uptrend. The British pound and the euro's getting kind of close, but we're not quite there yet when we compare it to the dollar. Gold is in an uptrend. The dollar index is in an uptrend. When you look at it by itself, the CRB index, that's a new addition to the list of this week. The big software companies, the mega caps, the FANG index, ARK, even though it's not really participating, it's still in an uptrend. The low volatility ETF by itself, but it's underperforming when we compare it to the S&P. Staples, the Dow Jones Composite Average, all the different bonds that we look at based on price are in uptrends. The tech sector, as well as the semiconductors, the high leverage loans, the Dow, the NYSE Composite, as well as the Wilshire, the NASDAQ 100, mid caps, small caps, and micro caps, all stocks, emerging markets, and I hope it shows up. Bitcoin at the bottom. Now, our list is pretty short when it comes to negative things, and this could actually get even shorter as of the weekend, the video that I do a week from now. This is when the 50-period simple moving average is below the 200-day simple moving average. Silver, okay, it's been bouncing up lately, but not enough to get into an uptrend yet. The Japanese yen is in a solid downtrend compared to the dollar. And that's it for right now. So thank you. Please feel free to check out the daily videos. There's a weekly video. After I do this, I'll be posting what I call the deep dive video. This is where I go through charts that might be telling us something, but maybe I didn't cover in this past week in any of the videos. And then the very last video I will do is called What to Watch. These are the charts that I'm really looking at right now. So have a very good holiday weekend, and I will talk to you in the next video.